Hi there. I'm going to prepare a video that will assist you in preparing the comparative financial statements for the Anderson hardware, which is in the example. Hopefully by watching this video and following along with me, as well as looking at your examples, it should all make some sense. Okay, the reason that we do comparative statements is so that we can compare one year to the next to determine whether or not the cost of our merchandise that we're buying is going up, going down. Are we spending more money on utilities? Are we spending more money on salaries? What exactly is happening in our business? So we're going to prepare a comparative income statement and balance sheet for Anderson Hardware. So I am going to type that in, and we're going to start with the comparative income statement. As you can see, I have the instruction sheet open to my left on the screen, and we're doing the comparative income statement for the years ended 2001, 12/31, and 2012/31. Because we're going to use 3 columns, we are going to merge and center that across columns A to C. There we go. Okay, so just like in an income statement, we are going to, because it's comparative, we have to do 2 years. Okay, so in the first column, we're going to put 2001, and we're going to go down and do all of that first, and then we'll go back and do the year 2000. Okay, so just like on any other income statement, the revenue section is first. And our revenue, if you look at your instruction sheet, is net sales. So our net sales for 2001 was $2,422,600. And of course I'll make that all into currency later. The next section is our cost of merchandise sold. So we want to figure out how much did that merchandise cost us that we sold. The first thing we need is merchandise inventory for January. When we think about merchandise inventory for January, if we're looking at the year 2001, the numbers given to you over here where it has merchandise inventory, okay, this is for the year 2001, but that's for the end of 2001. So the merchandise inventory at the beginning of 2001 is going to be the same as the merchandise inventory at the end of 2000. Okay, so we have 299,100. Okay, and if you look in your example notes, it does say end of 2000 beside that. Okay, the next thing we're going to do is we're going to add our purchases. Okay, and when we're doing this, we're going to look in our column for 2001. So in 2001, we purchased $1,505,200 worth of merchandise. So that will give us the cost of merchandise available by adding those two numbers together. Okay, hopefully this is making sense so far. The next thing we need to do is subtract merchandise inventory in December. So the merchandise inventory at the end of December 2001 is 283,100. When you subtract those numbers, that is going to give us our cost of merchandise sold. And I have given you all of the formulas so that you can use the formula to determine. Okay, when we take our net sales and subtract what the merchandise cost us, that gives us our gross profit on operations. Okay, so once again we're going to subtract. We're going to take our net sales, oops, forgot to put the equal sign. Net sales minus our cost of merchandise sold will give us our profit. So our profit is $901,400. Next thing we have to do is put in our operating expenses. And we have two types of operating expenses. We have selling expenses, okay, which relate to the selling of our merchandise. So those are things like advertising expense. I'm just going to pause while I type in a few of these things. Alright, so I have all of our selling and administrative expenses typed in now. Now we're going to put in the amounts. Okay, and once again, the amounts come from the 2001 column. Okay, so I'm just going to enter these numbers in. And hopefully you can see where I'm getting the numbers from. Okay, then we get to total selling expenses. So once again we need to add. So I'm going to add those. And then I'm going to put in the admin expenses. So those are expenses that you have to have in order to run your business. And I appeared to miss one, so I'm just going to insert a row here and put in other admin expenses. Okay, so then once again we get to our total, we need to add it up. We're just adding the admin expenses. Where it says total operating expenses, that's where we're going to add our total selling plus our total admin. Oh dear. Doesn't like that very much. There we go. So what we need to do then is we need to figure out our net income before federal or income tax. And sometimes it says federal income tax and sometimes it says corporate income tax. They kind of switch back and forth, so they're interchangeable. So to get our net income, we're going to take our profit and we're going to subtract our operating expenses. So we have gross profit minus our expenses. And you'll see we get a negative number. Okay? That's not exactly a good thing if you have a negative amount. Okay, so then we have to figure out what our federal income tax is, and it's $53,900. Oops, that shouldn't be indented anymore. And then we end up with our net income after federal income tax. Okay, and because we're subtracting, we need to have a single line there. So we're going to have equals our net income before federal income tax minus our federal income tax, And in this case, our net income has gone to 73,000, or net income, or in this case, a net loss after federal income tax. All right, hopefully we're okay with that. And we will now go along and do our year 2000. So when we're doing the year 2000, we're going to look at the column 2000. Our net sales was 3,178,600. Merchandise inventory for January, we have to look at the bottom of our page where it gives us the additional information, and that's where it's going to tell us that our merchandise inventory at the beginning of 2000 was 88,800. Okay, then we're going to add our purchases of 1,685,100. And I am just going to copy that formula across so that we have the correct number. Subtract merchandise inventory at the end. Now we're going to look in the 2000 column where it says merchandise inventory, and we can see that it's 299,100. Okay, and once again we're going to subtract those numbers, so I'm just going to copy that formula across. And I can copy the formula across for gross profit as well. I'm going to pause the recording again and enter in the expense amounts. Alright, so you can see that I've entered in all of the expense amounts and added them up. To get our total operating expenses again, we're going to add our total selling expenses plus our total admin expenses. And I'm going to copy the formula across one more time. And I see that I have an incorrect number here. This should be 158,800. So our net income before federal income tax is our gross profit minus our total operating expenses. If you look over here, our federal income tax is 104,200. And our net income or loss after federal income tax has now 402,700. So as you can see, in the year 2000, our profit was much higher than in 2001. Okay, in fact, we had a net loss in 2001. I'm now going to prepare a worksheet, or not a worksheet, sorry, a balance sheet with you, comparative balance sheet, so that hopefully then it all makes a little more sense. So I'm going to prepare it. Once again, we have the name of the company, Anderson Hardware. We're doing a comparative balance sheet this time. And remember, a balance sheet is always for a specific time period. So we've got 2001 12/31 and 2000 12/31. And once again, because we're going to use 3 columns, we're going to merge and center that across the columns. And we're now going to make that a little larger. There we go. Okay, the first part of any balance sheet is the assets. So we're going to list our assets. And first of all, we have the current assets. Okay, those are the shorter assets, ones that can more quickly be turned into cash. So we have cash, accounts receivable, sometimes you'll have a notes receivable and an interest receivable. In this example, I don't have that, but you do need to put those in. Merchandise inventory and other current assets. Oops, little typo there. Alright, so then we get to our total current assets, and the other assets that we have are fixed assets, and that may be recorded as equipment or several other options. Alright, so once again we need a column for 2001 and a column for 2000. Okay, so looking at our instruction sheet over here, we see that in the year 2001, cash was $76,400. I'm just going to type them in really quickly here. Merchandise inventory for 2001 is asking for the ending time, okay, or the ending amount, so that's why we're putting in the amount that comes from that column. So our total current assets are going to be added up. Then we have one fixed asset amount, $441,000. So our total assets are going to be $1,202,000. Okay, so the next part of any balance sheet is the liabilities, and once again we have current liabilities, and this time they're called long-term. Okay, so the current liabilities are, once again, those are going to be the ones that can easily be paid off if need be, whereas the long-term ones are the mortgages on the house that you may not be able to pay off quite as quickly. So our long-term liability in this case is going to be mortgage payable. And then we are going to have our total liabilities. I'm just going to pause again while I enter in these numbers. Okay, so I've gotten the current liability amounts in. We need to now add to get to your current liabilities. And our mortgage payable amount is $151,000. Our total liabilities is our current liabilities and our long-term liability added together. And our capital, or our shareholders' equity, okay, once again, those are interchangeable terms. So we have our capital stock, which in this case is $330,000. We have our retained earnings, which is how much we have earned over the years. to get our total shareholders' equity. So we're going to add those two numbers together. And when we add that together with our liabilities to get total liabilities and shareholders' equity, those two numbers added together should equal our total assets. So total liabilities plus our total shareholders' equity equals 1,202,000, which is what our total assets equals. So we're going to double rule those amounts because they equal, and we're going to fill in the same form for our the year 2000 amounts. I'm going to pause again while I do this, and I will be back to you at the end. Alright, so you can see that I've entered in all of the numbers. For the year 2000, our total assets is 1,413,100. And when I went down and figured out the total liabilities and shareholders' equity, it equaled the same amount. So everything balances. You can see that what we own from the year 2000 to the year 2001 has decreased by $211,000. So that would be part of what we need to do next, is analyze why that has happened. But we have one more thing to put in here. We need to record our capital stock outstanding, okay, which is the amount of shares that our business has. So we have 4,100. Oops, I got that backwards. 3,300. So we don't have as many shareholders as we did in the year 2000. Okay, the last thing to do is to make all of these amounts into currency with no decimal places, just because it gets really, and no symbol. Alright, so there you have the comparative income statement and comparative balance sheet. I hope that that is helpful in your abilities to continue on with Accounting 30. Thanks so much.